Hi, Chris Maloof with Cross Country Financial here. As a follow-up to a video we posted a couple weeks ago in regards to the bond market and tough interest rate environment, are you curious how to generate income in your portfolio? Stick around, we're going to give you a couple ideas. Interest rates have risen steadily over the past 6 months, but remain low by historical standards. That means the traditional high-quality bonds that many of us owned for decades are not doing the job for investors looking for income, while the potential for interest rates have risen steadily in recent months brings more risk in the bond market than has ever been evident historically. Here we're going to look at some income ideas that may help with these challenges. When investors think about income or yield, they would normally think bonds first. More on that later. Next, they might think about getting extra yield from their stock portfolios, maybe with a dividend strategy that might be heavy on real estate investment trusts and utilities. While we don't have anything against using those types of strategies for a portion of a portfolio to get some yield, they can also carry unwanted interest rate sensitivity if rates rise. We're going to highlight some equity income ideas that we would expect to perform well in a rising rate environment for you to consider when building your portfolio. Income idea number one, energy. The first idea is energy stocks. You may be surprised to learn that the energy sector currently yields about 5% based on dividends paid in 2020, topping all of S&P 500 sectors. In our Global Portfolio Strategy report, we upgraded our view of energy sector to neutral. Our increased optimism was driven primarily by these three factors. First, as we get closer to a fully reopened economy and travel activity picks up, potentially in the second half of this year, energy is likely to be a big beneficiary. Second, our technical analysis work revealed attractive upside potential based on recent price appreciation after an extended period of weakness. And third, we see this sector as attractively valued, especially when considering the income potential. But keep in mind, the dividends can be cut, so this investment is not without risk. Oil prices can be volatile, and alternative energy is gaining market share. So this may be more of a medium-term trade than a long-term investment. With that said, we believe the chances are good that oil prices at least hold steady in the $55 to $60 per barrel range this year, sufficient for the sector to maintain rich yields while potentially seeing some additional price appreciation on top of the 17% year-to-date gain. Income idea number two, banks. You may be surprised to see banks on here as another income idea. The financial sector, which we upgraded in our January Global Portfolio Strategy report, carries a dividend yield of 1.9%, but banks yield 2.6% based on the S&P 500 Bank Index. Although plenty of bond strategies carry yields in that range or higher, banks do not bring the interest rate risk that bonds do. Historically, bank stocks have exhibited positive correlation to interest rates. The stocks have tended to outperform as yields have risen. Bank stocks also tend to like a steepening yield curve. Long-term interest rates rise faster than short-term rates. We also expect bank dividend payouts to rise over the next year or two as the Federal Reserve eases up on payout restrictions. More progress on vaccine distribution should also enable a fully reopened economy and drive stronger economic growth, which should bode well for the profitability and therefore dividend payout potential for the financial sector. Yields from banks may not look great on the surface, certainly not compared to the energy sector or some of the higher yield segments of the bond market, but in a low rate environment with rates more likely to rise than fall, in our view, we think banks can make sense of income-oriented investors with an eye toward total return. Income idea number three, bank loans. There are a number of fixed income options that may be suitable for income-oriented investors. For investors looking to limit interest rate risk, bank loans may be an attractive option due to the improving economic environment and limited rate sensitivity. Major fixed income sectors by income per unit of interest rate risk, fixed income indexes have different degrees of interest rate sensitivity. This exercise allows us to determine compensation for taking on interest rate risk. Bank loans are an obvious standout by this measure, offering potential yields in the 4% range with extremely low interest rate sensitivity. While the actual yield bank loans offer in the future is not certain, this analysis does show that bank loans provide an attractive income option relative to other fixed income alternatives for investors looking to limit interest rate risk at the beginning of a possible rising rate cycle. It's important to understand the trade-off between interest rate risk and credit risk. We know there's no such thing as a free lunch. That additional income compensation comes with assuming credit risk. That's the risk of default or credit downgrade and the risk that prices drop sharply in a risk-off environment if demand suddenly dries up. Conclusion. Yields across much of the fixed income market are low, which leads us to increasingly look to the equity market for additional income. Our preference for stocks over bonds, supported by low interest rates, is one of our highest conviction recommendations. Several segments of the equity market, particularly the energy sector and banks, offer higher yields than traditional high-quality bonds and offer attractive capital appreciation potential as interest rates rise. For suitable fixed income investors looking for yield and concerned about rising rates, we believe now is a good time to give bank loans a look. If you found this information beneficial, hit that subscribe button, and we'll see you here again next week.